That's okay. Welcome back to Phased, Peter. Here we are, almost another year in the books. I'm interested in your look ahead for 2024. What's top of mind for you going into a new year, Peter?
I'm still focused on how the economy continues to acclimate to this higher rate environment. Obviously, 2022 was the rate shock. 2023 was the celebration that while the Fed continued to hike as the year progressed, they were slowing down the calibration of those hikes and obviously eventually stopping. Uh, but I do think that a lot of the aggressiveness with respect to those hikes are still working its way through the economy. And every day somebody's loan is coming due. In 2024, we have about $700 billion of investment grade bonds that need to be refinanced. You got about a $500 billion of commercial real estate loans that need to be refinanced. That even if the Fed cuts interest rates next year, which they will, I just doubt it'll be as aggressive as the market expects. Uh, Even if they cut to 4%, which is what the Fed funds futures market is pricing in right now, that's still a far cry from zero. And it still means that there is still a refinancing reset that's taking place. And, the economy is globally is challenging to begin with. And that's not coming from me. It's coming from about every single company that reported earnings over the past 2 months. They said it themselves about a challenging macroeconomic environment.
Yeah, was
So it's
FedEx today or UPS today? That's take.
FedEx. You had General Mills in their earnings release that's obviously selling, pet food and cereal, talking about a discerning customer. You had
Wow.
Accenture yesterday in their earnings call talking about more slower decision making taking place in terms of projects. But it's something that we've heard throughout
That's something.
earnings. Is
That's something about pet food, Peter, because people will treat their dogs better than their relatives and even themselves. They'll go hungry so their pets can eat.
Well, what's
So,
happening? What's happening in the pet food business, and I know this because we're involved in a stock that we own, is that yeah, you still have to obviously feed your pet every day, but the consumer is going to the more value type food,
back to
whereas
the
before they might
pellets.
have been buying premium instead. So they're
Right,
they're buying Purina
right.
instead of the higher end stuff, and they're buying less sort of supplies or toys
Okay.
when they go to the pet store or ordering online. So they're still obviously caring for their pet and feeding it. It's
Yeah,
just not to the extent that they were beforehand.
yeah.
Uh, but that's what we're seeing
Well, that
in a
tells you they're
variety of different
stressed
hotels.
if they're looking to save in an area like that. That's my takeaway from that.
Yeah, there's no question. I mean, we heard from Walmart and Target and the dollar stores how consumers are still prioritizing their spend. They're being quote unquote choiceful. I heard that word used a few times. I didn't even know it was in the dictionary
Yeah.
about how consumers are spending. And then on
Okay.
the other parts of the economy, you have manufacturing that's in a recession globally, and FedEx, confirmed that with their earnings release. You have the housing market that's sort of backwards, where new builds for the bigger home builders are doing well. The smaller builders can't get financing, and the existing home market, is in the doldrums. So it's very, very much a strange economy. You have the higher end consumer that continues to spend. They're
Yeah.
benefiting from both having jobs and collecting 5% interest income on their savings. Whereas the lower income person, while they've had some nice wage gains, they're dealing with the cumulative effect of a 20% rise in inflation over the last 3 years and concerns about that.
Okay. I know you're a China watcher, and G was here. We heard what he talked about a little bit with Biden, but I would think that you'd be licking your chops at how cheap uh, China has gotten with the U.S. market, almost in a parabolic move to the upside. Do you think it's China could end up being a nice recovery play in 24?
My 2024 call is the Hang Seng outperforms the S&P 500.
Oh,
And I've said
nice.
this
Okay.
multiple times. I was at a conference in November, and I made that case. I
Okay.
think that that's going to be so. The thing with China is, you need to pick apart what's going on over there, and their manufacturing sector is dealing with the same challenges as the rest of us. Consumers are obviously switching their spend from goods to services, and also the inventory destocking, which I think has pretty much run its course. There has really been no signs of restocking, and FedEx actually talked about that in their earnings call last night. With respect to the China residential real estate situation, yeah, that's in a really distressed situation. But
Yeah.
China is at least approaching it, I think, the right way in the sense of forcing a lot of bankruptcies upon these developers
Instead of
and trying
QE.
to and trying to cleanse the system. And
Okay.
cleansing an overheated system is always a painful process. Then
Right.
you also, of course, have the leverage on the bank balance sheets and local government financing. So there's still a lot of challenges in China, but it just has to be less bad. And I think the Chinese consumer, another year, will be distancing themselves from the PTSD of COVID. And there's still a large pile of savings there, even though real estate wealth is being compressed with what's going on in that part of the economy. But I think there's enough all in to make it less worse. And
Okay.
that is all you need to see an improvement in their markets.
Okay. Why Hang Seng over Shanghai against the S&P?
Uh, I think, well, there are Chinese stocks that trade there. I think that it's um,
A more liquid
a
market.
cleaner way of basically saying let's buy the H shares instead of the
Okay.
A shares.
Got it. Okay. All right. So, how about energy, Peter? Are you worried about what's happening geo-wise in the Red Sea for supply chain issues with WTI?
So it's always something that we have to obviously worry about. You wonder though whether the U.S. and I forget who. I guess it's probably the EU that are
You,
putting forces in the Red Sea to try to
yeah.
create a safe space for a lot of these ships. I want to believe that there's not really going to be the supply disruptions that cause a problem. I think that stabilization in China or being less bad, as I said, uh, will be enough to lift oil prices. I still think that U.S. production has saved the day this year in terms of bringing enough supply to the market. But when you look at a chart of the U.S. rig count, it's done nothing but go down this year. And the reason why
Okay.
U.S. oil production has done as well as it have is just because the efficiency of these existing wells. But you just have to wonder how much longer can we sustain such a high level of production with the rig count going down every single week. So I still like energy. We've been more in the owning the European energy stocks that have outperformed the U.S. ones just because they've been so much cheaper, and that still
Okay.
remains the case. And I think down to $2, you got to be buying natural gas hand over fist.
Okay. Okay. And here we are. So, okay. There's your spot on that gas. So, is it weather market you're looking for, or is it the arbitrage between us and Europe that makes U.S. nat gas attractive down here?
It's never easy to bet on the weather. I think it's and it's happening in shale spots around the country. It's just depleting wells that just
Reserves?
aren't
Yeah.
producing, to the same extent, and that there's just the natural sort of degradation of a lot of these wells that, while initially very productive and prolific, sort of wear down. And I think that's the case in a few different shale basins in the U.S. And so when nat gas gets to around 2, you look at a chart, it's been a pretty good spot to add.
Okay. Yeah, here we were. I actually thought we had a breakout here, Peter. came out of a saucer bottom. Maybe we have to base again down here, or even like maybe a panic under these lows. Or
I mean, we'll see what the winter weather is like.
yeah,
Uh, that's always a wild card. I mean, last winter Europe had was given a
a
gift
warm. Yeah,
with warm weather.
yeah,
I would have to believe that this winter is going to be cooler than last, but they're also well supplied. So we'll see. It's always I never like to bet on weather. I'm looking more big picture and a multi-year time horizon. That
yeah.
you know
Supply side.
yeah, that's my focus right now.
Okay, and do you think that this bond rally is long list, a long lasting move that could, stretch higher, or was this just maybe some short covering and we head back down again? Did this bond rally surprise you?
Well, it's you had a couple things. So basically, the 10-year yield is back to where it was in late July, where it took off. And remember, late July was when the
Yeah,
Bank of Japan widened yield curve control. That to
right.
me lit the fire for the rise in interest rates. And
Okay,
then, as the months progressed, you had a slowdown in European CPI. You had the Bank of Japan in subsequent meetings saying they're not looking to change their NERP policy anytime soon. You obviously had the Fed backing off, all combining for this big rally, but just takes the 10-year yield back to where it was about 6 months ago.
yeah,
I do think that bigger picture, there's still challenges on the long end. Short end yields certainly have topped. I mean, the Fed will start to cut, and
good.
I still like being in the short end, but the long end is still dealing with these big picture challenges of at some point in 2024, the BOJ will get out of negative interest rates. We saw the October tick data last night, where the level of foreign holdings of U.S. Treasuries is back to where it was in July 2021. That's even after the U.S. Debt in marketable securities has gone up 4.3 trillion. So the foreign holdings of U.S. Treasuries continues to shrink. Fed's still
Right.
doing QT. Banks are
Yeah.
still reducing their allocations to Treasuries. So I still think you have this supply demand imbalance that
Okay.
is going to rear its head again.
Okay. So, it may not be because of inflation. It could just be not no demand for all the supply coming to market next year. That I know I was talking to a Fed guy, and because I think there's a chance that could we have a repeat of the 70s, Peter, where we tightened. I think it was Burns, and then he thought we were uh, we inflation was handled, and then it reemerged, and they had to go back on a tightening campaign again. I think it was three times, and Volcker was the third tightening regime during that decade in 1979. Could we end up seeing over 5% yields in 2024 wherever they, pull back to? I know some people are talking, big moves. Some
Yes, you can, because there are a bunch of different dynamics here. The Fed starts to cut interest rates aggressively. You can see the dollar fall further. That can
Yeah,
raise input prices. That can raise the price of oil.
right.
Looking at over the next couple of years, higher interest rates does impact negatively the demand side for the economy, but it also affects the supply side. I mean, right now, you take the multifamily part of the economy, and because rents are the biggest chunk of CPI, there is a huge amount of apartment supply coming online in 2024. Those are the buildings that were started a couple of years ago when money was easy.
Yeah,
So rental declines will take place in 2024, but there is very little new multifamily construction beginning right now because these deals don't pencil out. So
yeah,
2024, we're going to get a flood of apartments. 2025, there's going to be a dearth of apartments. So rental growth will decline next year and inflect higher in 25 and 26. You take the transportation sector, the manufacturing recession is knocking out trucking companies left and right. So over the next year, if the economy continues to slow, you're going to see a lot of trucking capacity come out of the market. And at some point, prices are going to firm up, and transportation prices, after having collapsed, they're going to inflect higher again. So we're damaging the supply capacity of the economy, just as we're negatively impacting the demand side. So you'll get a temporary cooling of inflation, but an eventual increase at some point, maybe second half of 24 into 25.
Okay, because supply is not expanding because people are pulling in their horns, and
Yeah.
also and the interest rate scenario, like you were saying, a lot of things
Well,
don't pencil
that's
out.
it. Yeah,
Yeah,
exactly. So you're going to get, I mean, look at office, which is obviously depressed. Well, you can be sure for the next 10 years, there's going to be very little office supply.
right.
Look at looking at the shopping center business or the big malls.
Yeah,
Has there been a new big mall built in this country over the past 5 to 10 years? You can probably count on one hand. So the mall operators have pricing power because of the last 10 years of excess. The shopping center guys have pricing power because of the last 10 years of excess, where there's just no new supply. So that sort of lays the foundation for an eventual acceleration of inflation. But at least for now, we're going to enjoy the deceleration of inflation until those other factors kick in again.
maybe by mid-year we start seeing that stuff, Peter.
I would say the back half of 24 because you're still going to have a further deceleration in the rent calculation as
Okay.
it plays catch up to what's going on in the real world. I mean, there are apartment landlords out there left and right that are offering concessions. Uh, there is definitely going to be a depressant on the rent side of inflation throughout 2024. Question then is, which will keep a lid on services, but on the other hand, you have wage growth that's still probably going to be 4% next year, uh, and that will keep a floor under other service parts of the inflation stats. And then we'll see what happens on the good side, where we're sort of back to zero on a year-over-year basis, which ironically was the pre-COVID trend in core goods prices was zero. I don't think structurally it stays here at zero. We'll see whether it ticks up again, but at least for now, it's at zero.
Okay. I know you've been constructive on precious metals for a few years. Looked like we were going to have a big breakout here in gold, and I don't know, they were able to turn it back, but I don't think this is going to be a long-lasting high. You have some upside targets in gold and silver. I know
When
you don't
you
like to
look at,
trade it. You don't want to get, you would use the term, well, I'm not going to trade it. I'm not going to get cute and then
well,
miss everything. I
well
do
that
that.
that's yeah, well that's sure the case. I mean, when you look at how well gold has traded over the past 2 years in the face
Right.
of
I agree.
such huge aggressive, I mean, we're talking about a real rate that went from minus 200 basis points to at its peak this year plus 250 when you look at the 5 year and the strong dollar, and gold was up over those 2 years. I mean,
Yeah.
what an performance. And now you give me lower rates and a weaker dollar.
Yeah.
I mean,
Tailwind.
I don't know what's now in the way of gold
I
on the
don't
upside.
either. And you know what? Either do the miners, Peter. And they've been underperforming for quite some time. I noticed on the last pullback in physical gold and silver that they barely took anything out of the miners. Are you warming up to them? And
So
maybe in different countries?
yeah, no, we're along some of them. I think the problem with being a mining shareholder over the past 20 years, there are few other forms of masochism. Uh, it's probably the worst business that you can possibly decide to enter.
Yeah.
And that's been reflected in the performance of a lot of these companies over the past 20 years. But I do think that there's been a level of efficiency and religion that these CEOs have taken on,
Yeah,
and
they
that
used to have a lot of debt. They carry massive debt. That's what killed them.
yeah. But
But
now the balance sheets for the bigger ones are much healthier. They're
yeah,
generating very healthy
here's
cash flows.
here's one with no debt that actually pays a 4% dividend, 4 or 5%.
When you have 1,200 all-in sustaining cost and you can
Yeah,
sell your product for 2 grand, you're making a
yeah,
pretty fat profit margin. So
Yeah.
I think there's a party to be had for these miners to the upside, as they are
Okay.
nowhere near close to pricing in a sustainable $2,000 price of gold.
Look at where they used to be.
I mean,
Okay.
the GDX ETF was twice the
Here it is.
price the last time gold was
Yeah.
around these levels.
Yeah,
Now,
it was
granted, their
56.
cost, yeah, now granted their cost structure was lower then, but um, there's a lot of cash flow being driven by those that are pulling the stuff out of the ground.
Technically, I just noticed it's a big symmetrical triangle that goes from 16 to 44. That's $28. So if we ever get a 36 breakout, it's going to give you 64. So back above the levels from 2011 could be in the cards.
I think we're going much higher in gold, and silver is going to come follow.
Okay. Is there ever going to be gravity in the S&Ps? I mean, we're only a layup away from new all-time highs where we have it in NASDAQ. Are we just going to be parabolic? I've talked to people who said this is the last phase of this, you could call it a 40-year bull market from 1982 if you go back that far. And you've been in the markets long enough to know that normally abnormal things happen near the end of a bull market. That's when the biggest moves, parabolic moves happen. Do you think we're just going to keep blowing off and headed towards, I think you said earlier you could make a case for 5,100. Is that what you said?
No, no, I never
Oh, okay.
made that
All right.
case. I
So,
mean,
so what do you think? I mean,
so
here's
I
the,
in the very short term, technically speaking, you have the S&P, the 7 and 14 day RSIs are the highest level, and the other day they were the highest level in 3 years, and yesterday they might have even exceeded that. You have
yeah, here you
the
go.
AAII and the II numbers pretty extreme. You have the CNN Fear Greed Index that went into extreme greed. Um, there's a level of giddiness there that, at least in the short term, will probably make it tough to see much further gains. And then you always, the market's not going to just slice through its record high. It's when you get to that record high, the people that bought the previous record high, they say, oh, now I'm back to break even. And so there's going to be a level of resistance here. The problem with the market is that it's just very expensive again, trading at 21 times 2024 earnings. When you get to these multiples, there's no room for error, and rates are not zero anymore. The when you look in the 2010s, the I'm sorry, the 20s, the 10-year yield around 4%, the PE
Yeah,
multiple was about 17.
yeah.
A 21 multiple I can understand when rates are zero, but rates are far from zero. So I think the market is grossly overvalued. So that's the challenge that it has. At the same time, earnings growth in 2023 was zero. Earnings growth in 2024 is right now currently, I believe, well overestimated at about 10 to 12%. Uh, Nominal GDP with slowing inflation is just not going to grow fast enough to generate that kind of earnings growth. So you're going to have a multi-year period with no earnings growth, still high interest rates, and an egregiously overvalued market, at least for the bigger cap names. Now, the smaller cap names, definitely cheaper, no doubt.
Yeah,
International
Russell.
markets,
Yeah,
much cheaper, no doubt. I'm talking about the names that dominate the S&P.
Mag 7.
They're grossly overvalued in a mediocre earnings story, and even those names, their revenue and earnings growth have become much more pedestrian.
Okay, so with your call for a weaker dollar, and I agree with you, even though I think from 101 we could have one more dollar rally, but not above 105. Should we be looking at emerging markets here, Peter, with the dollar, that could be in for a prolonged bear market that takes it, into the 90s, maybe 80s? What would be your favorite markets outside of the U.S. in
So
24?
I'm very bullish on emerging markets. I told you about the Hang Seng. We're
Okay.
long Singapore, Vietnam,
Okay,
uh,
Asia. Okay.
even Japan, which is obviously not a developing market, but still will benefit from an improvement in the region in Asia. We're long some Chinese stocks or beneficiaries of, like Macau casino stocks and
Okay.
um, and some other names, and very bullish on local currency emerging market sovereign bonds that pay a good yield that I think can have that currency kicker. So I think EM managed the last couple of years rather well in terms of inflation because their central banks never went down the rat hole of zero rates and QE and were pretty aggressive in raising interest rates. I think it was the Mexican central bank, the Brazilian central bank, they started hiking in early 2021. The Fed didn't hike until March 2022. So I think the bonds of these countries and the currency exposure is pretty attractive.
Yeah, I mean, the peso has been strong for a while, even when the dollar was strong.
It's been tremendous.
Yeah, so here's Mex. So still looks like, wants new lows, which means a stronger Mexican peso. And, they also talk about, and we'll wrap it with this, all the reshoring of our industrial base. Mexico's a big beneficiary of that. A lot of people bullish Mexico, Peter.
Yeah, so Mexico's certainly been a beneficiary of even the Chinese that are building factories in Mexico, no doubt about it. So there's still globalization. It's just shifting to different parts of the globe.
All right, a quick comment. It's an election year. It's going to be crazy, isn't it?
Yeah, there's going to be a lot of vitriol and a lot of noise.
Okay, but we shouldn't worry about it. We should just turn the volume down on our TV.
Yeah, it depends on what level of torture you want to give yourself. There's certainly going to be plenty of entertainment involved. There's no doubt about that. But there's going to be a lot of cringe-worthy moments.
Okay. Well, the moments we spend with you, Peter, over the last 6 years, it's always had value. And I appreciate you contributing to our community as you have for this amount of time, and wish you happy holidays, you and your family and associates and friends. And I hope you have a great 2024, Peter Boockvar.
Thank you, Dale. I appreciate having me on. I always do. I'm always grateful for the opportunity and always fun chatting.
All right. Peter Boockvar, follow Peter and sign up for his letter, and, keep in touch in 2024 with what Peter's doing. And I think I had it up here, but just go to @pboockvar on X and you could get to it. So thanks, Peter. Happy New Year too, bro.
Happy New Year. Happy holidays.
All right. So that's a wrap, everyone. Hope you enjoyed Peter. Likes the emerging markets. Right? Bearish a dollar. Metals look good. The masochists and miners may have their day. And I'll see everyone tomorrow, TGIF, for the end of the week going into the Christmas weekend. And I'll just say, it's gonna be a blue, blue, blue Christmas without you. Don't just count your pips, count your blessings. See everyone tomorrow, okay?
Hey traders, this is Blake Morrow with Forex Analytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.